From New York City for our viewers worldwide, I'm Matt Miller in for Jonathan Ferro. We see markets futures up after the Fed signaled it's done with rate hikes. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, Chair Jay Powell signaling the Fed could be done with rate hikes, boosting futures after stocks record their biggest three-day rally since March. As investors look ahead to Apple after the earnings, after the bell, we're going to get earnings. And we begin, though, with the big issue, countdown to the payrolls report.
The real test will be on Friday when we get the employment report.
The jobs report.
The jobs number, is going to be incredibly important.
It's always important.
The labor market remains actually fairly hot.
Just, very strong.
Still extremely tight.
Last month it was 336,000 jobs. We're expecting around 200,000 jobs.
Expectations are it's going to go the other way.
We are gradually seeing a slowdown in the pace of hiring.
The job gains have indeed slowed.
We'll see if that slowdown continues.
Continued moderation in the labor backdrop, even if it's uneven, I think is going to persist.
Labor market is the key right now. Key indicator.
Key thing that investors across asset classes are going to be watching.
Everybody's trying to figure out what the underlying trend in the labor market is.
It all comes back to jobs.
We'll see what non-farm payrolls gives us on Friday.
Joining us now to discuss is Lafayette's Krishna Mamani and Seema Shah of Principal Asset Management. Seema, let me start with you. What do you think payrolls is going to give us in addition to all of the news, the refunding, the Fed decision that we've already had?
Hi, Matt. Well, I think the key thing for payrolls is really about how much support there is for the consumer. So we've already seen that the consumer is really strong. We know that that has been the focal point. And one of the things that is underpinning forecasts for a downturn next year is this assumption that consumer spending starts to weaken. That doesn't happen if the job market remains as strong as we've seen. So I think it's going to be key to watch, obviously tomorrow, but obviously, how is the job market evolving over the coming months? And are you starting to see some of that job pain that would maybe take out some of the foundations for the consumer?
Krishna, do you agree? Our own Anna Wong here, the chief economist at Bloomberg Economics, has put out a report today showing that, non-farm payrolls, whatever the number is, it's not indicative of a recession coming. It's not a very good indicator.
Well, so I won't debate whether it is a good indicator or not, but I think given what is going on in the rest of the economy, I think expecting payrolls to correct in a big way or for us to even get anywhere close to a recession at this point, I think the likelihood of that is basically zero. We had a 5% quarter. And when you have a 5% quarter, things may slow down, but the momentum is enough for you to carry through at least for another quarter or two. So I think expecting
another quarter or two at what?
A recession
at what?
in the
At like
US
0.2, at 0.5, or do we get a quarter or two at 2.5?
Well, that's a good question. I think the expectation is that it'll be low, and I would say that is probably misplaced at this moment. I think we don't get a 5% quarter, but I think it's quite likely that we end up being 2.5 range rather than 1 or lower than 1 at this point.
Seema, we're showing in a box the 10-year yield as we talk about this, and it's pretty amazing to see it now at less than 463. I mean, it really has plummeted since we got the refunding, since we got a dovish Powell. What do you expect for the economy, given that the Fed has kind of already given us its view that it's still strong enough and inflation is coming down fast enough that we don't really need any more rate hikes?
Yeah, this plunge that you're seeing in the 10-year is really interesting because imagine what Powell would say today if we were doing the press conference now and looking at the drop in bond yields. I wonder if you'd have a very different narrative to the meeting. So look, I agree. There is a very, very strong economy. Given the growth rate that you saw in Q3, Q4 is likely to be a strong quarter. Not 5%, but certainly the 2 to 3% range seems quite likely. But from there on, and assuming there is a big assumption here that the consumer does start to weaken, along with a number of headwinds that have been repeatedly listed, At some point in early next year, we would expect there to be a downturn. Now, recession, not recession, I think these are almost kind of irrelevant almost discussions, because what we're expecting to see is a downturn where maybe you see a couple of quarters of negative growth, but the rise in the unemployment rate that you could see will be nothing like or nothing comparable to previous recessions. So a downturn, but this is certainly not a deep downturn that we're expecting.
All right. I think Bloomberg Economics is also still forecasting a downturn sometime around the turn of the year. Let's get over to Mike McKee right now, because the focus is shifting from the Fed to the data, less than 24 hours until the U.S. jobs report. But as Seema Shah points out, Michael McKee, it's interesting that yesterday Powell was saying these rates are doing our work for us, essentially. We've heard a slew of Fed speakers say that. And now these rates are getting much lower.
Yeah, Matt, but let's talk tomorrow at 8:31. I mean, if we get a surprise like we did last month, 363,000 jobs, I bet you those rates go back up again. Everybody is trying to decipher what the Fed is going to do, and obviously Jay Powell had trouble answering my question on that yesterday. But the important thing that he said is this: evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. So we don't have to grow a lot more than 2%, but if we grow a little bit more than 2%, and if the labor market doesn't ease up, then it keeps a rate rise on the table. And here's the latest data. Obviously, 4.9%, we're well over potential growth. Payrolls expected at 180, but that's still quite a strong number. And unemployment doesn't go up. The Fed was thinking we'd be at 4.1% by the end of the year. Let's see what happens on Friday. JOLTS came in even higher and suggests the labor market is not tight. Jobless claims are not giving us any of those indications either. And the good news we got today is maybe some of this is all sustainable, because productivity went up more than forecast. And the only time, I mean, you look at this here and you can see productivity spikes after recessions, when companies have let people go and those workers who have to now deal with a recovery have to do more work, except for in the 1990s, when we saw the Alan Greenspan productivity boom from personal computers. Now we're seeing strong growth in productivity again. Does that continue? Because it's coming as the labor market is not tight, and we've done a lot of hiring, not after a recession when a lot of people have been let go. Does it continue? That'll be the question. But it does suggest that if it does, there is an opportunity here for us to perhaps maintain a little bit stronger economy without the Fed having to react.
All right, Michael McKee there, our international economics and policy correspondent down in Washington, D.C. Krishna Mamani and Seema Shah still with us. And Krishna, I want to just quickly get your take on the 10-year yield as we watch this drop. I think it's one of the most interesting market moves I've seen in at least a few weeks. I mean, the other more interesting market move was the 10-year on the way up through 5. Right now we're at 4.6. What do you think about that?
Well, so I think Mike McKee is absolutely right. That is, let's not derive too many conclusions out of one day's moves. Yesterday, everything came together, and the market reaction probably is related to everything coming together. And things could change dramatically tomorrow. I think from a rates perspective, we are in a purgatory. It's a good purgatory, but a purgatory nevertheless, in that we are going to have gappy moves both on the upside and the downside without really having any significant direction. I think if the 10-year gets to, let's say, 4.5, the upside from there on is very, very limited in my view. So I think we may like it today, and we liked it yesterday for sure, but counting on it to persist, I don't think that is in the cards given the underlying momentum in the economy in the current quarter.
Well, and to be fair, you've been saying this for a while, Krishna, that you think, we're at these levels and we don't know the direction, even though we're going to see these, annoying or frustrating gaps up or down and try and make sense of them. Seema, what do you think about the volatility that we've seen in the bond market, and how closely is it tied to, the debt and deficits we've been talking about so much more lately? All of a sudden, it seems like the market cares, kind of. Do we really?
Well, so we do. I think if you're a long-term investor, you have to be looking at a range of issues, and we certainly know that the move in bond yields is not just down to one single factor. It's not just down to rate expectations. It's not just down to the Bank of Japan or issuance. There's a number of different factors which are at play here. And certainly, to Krishna's point, it does make it difficult to see 10 years sustainably lower, or down certainly near the low fours anytime soon. So I do think that we're in a higher range. That volatility does mean that, of course, it's very easy to be swept around by the various moves. I think as an investor, you take a longer term perspective. You look at over the 6 months, 1 year horizon, and what you're likely to say, from my perspective, is you're going to see a bit of a slowdown. So you could see some downward pressure in bond yields, but you're not going to go back down to those 4% levels soon.
Krishna, what do you think about the stocks? We've seen the correction at the end of last week, and now 3, maybe 4 days of rallies. Are we off to the races, or is this also another one of those gaps that just frustrates you?
So I think if you look at valuations and you look at rates and you look at the underlying growth momentum in the economy, I think the likelihood that stocks correct in a big way, I don't think is in the cards. In the same vein, given where valuations are and what earnings growth is going to be, expecting a big up move in stocks is probably not in the cards. As I said, we will have moves up and down, and we'll lose our collective mind trying to figure out a direction when there's really none forthcoming.
I wish we had one collective mind. I would be a lot smarter if we did. Seema, what's your take on, earnings have been much better than we thought they were going to be at the beginning of this quarter, right? Just like GDP, I guess. If we see a slowdown, how hard does that hit companies?
Exactly. The earnings season has been very much like the economy. You've got a very strong hard data, strong earnings, but it's really about the guidance. It's about what the concerns are, is what comes down the line. We do believe that earnings growth forecasts are too high. There's too little emphasis being put on margin compression for next year. Certainly, if you continue to see inflation staying lower and falling even further, then margins will be under some pressure. So I think that there is space for negative surprises in the earnings picture for next year. In terms of what that means for equities, though, I agree with Krishna. You're unlikely to see a very, very big downward move, because what we're anticipating is, even though it's a downward surprise for earnings, it's not going to be a big drop. It's not going to be a big crash. So I think as an investor, again, take a long-term view. This is a fairly range-bound market. It's a volatile one, but it's quite range-bound, and you need to be looking for the various value opportunities and certainly focusing on strong balance sheets for the time being.
Krishna, I want to ask you about the inflation picture. It's obviously had a huge impact on margins up and down. And now, I know the Fed uses the core PCE or the super core, right? But if you, I look at CPR from Infrastructure Capital Advisors, they just take core CPI, and they take out the kind of misleading rent equivalent, right? And they replace it with Case-Shiller index. That shows we're well under 2%. If you look at Cam Harvey yesterday from Duke was saying also that if you take out this misleading, housing data that they put in there, we're well under the 2% target. So how do you see inflation?
Well, I think what I think doesn't really matter. What matters is what Powell and the FOMC thinks. And I think they told us that yesterday very, very clearly. That is, they're pleased with the direction of inflation, but it is not coming down fast enough. And I think there's some risk that it probably goes on the other side, or goes the negative way, increasing slightly before the end of the year. So I think inflation is, again, it's coming down slowly, and I think expecting a very dramatically different direction in inflation, I think is not warranted. What that means is no Fed cuts for the any decent investment horizon that you can think of at the moment.
Very, very good and important reminder. What we think isn't quite as important as what Jay Powell thinks, and he's looking at the data that he's looking at. Krishna Mamani and Seema Shah, thanks very much. Joining us now with a look at the stocks moving ahead of the opening bell. Let's bring in Abigail Doolittle.
Well,
Abby?
Well, we do, of course, Matt, have the S&P 500 mini futures surging, in fact, up for a fourth day in a row, heading to the best week since November of 2022. Helping out today, take a look at Palantir, surging 17%. They put up a record profit. It was 7 cents, but nonetheless a record profit. And it's a fourth consecutive quarter of a profit and beating. Starbucks up 11%, a 10% adjusted earnings beat. They beat sales as well. The outlook was cut, but the same-store sales being up 8% versus the 6.3% estimate, investors liking it. And then finally, Qualcomm, solid quarter, better forecast. Well, that means, Matt, that investors think that perhaps some of the mobile phone glut, that the glut in inventory, well, it may be easing.
All right, Abigail, thanks very much. Abigail Doolittle there looking at some of the stocks. Just about 15 minutes away from the start of trading, and futures are higher. Plus, we have a very important interview. The CEO of Novo Nordisk, Lars Fruergaard Jørgensen, joins us. The company posting blowout results as the obesity drug frenzy. GLP-1, is it a fad or is it the way forward? That conversation next. This is Bloomberg. This is the countdown to the Open. I'm Matt Miller, in for Jonathan Ferro. A Danish pharmaceutical company is enjoying monster success with two of its new products. Novo Nordisk raising its outlook for the third time this year thanks to Ozempic and Wegovy. You may have heard of them. The company's new diabetes and obesity drugs. Shares nearly doubling over the past 2 years, making it Europe's most valuable company. Bloomberg's Katie Greifeld is standing by with the CEO. Katie?
Joining us now is Lars Fruergaard Jørgensen. I'm thrilled to say, Lars, it's great to have you here. And I don't really need to say that obviously demand for Wegovy is just skyrocketing right now. So let's talk a little bit about supply, where clearly we've seen issues specifically in the U.S. where you've limited starter doses. When should we start to see some of those supply constraints start to ease?
Yeah, thanks for having me today. You're right. This is a really exciting moment where we see tremendous demand for our medicines. We have a keen focus on making sure that patients get a good experience. So we want to make sure that those who start treatment can also continue treatment. And that's why we have taken the starter doses down to make sure that when you titrate up, you can have a good experience on the maintenance dose. We keep increasing our capacity, as just explained by the recent upgrade. As we look to the future, we'll be gradually expanding and bringing more and more product to the U.S. so we can continue this innovation-based growth strategy. Specifically, how and when, I cannot go into much details about, but you can trust there'll be more and more supplies coming to the market.
Well, Lars, you said previously that in terms of the starter doses, we should expect to see those limits stretch into 2024. Is that still the timeline?
Well, we see it's a dynamic situation. It's obviously also a function of demand, how we have to handle these starter doses, and a function of how we supply. So we'll not go into specific guidance about it, but for the remainder of the year, you'll see the starter doses being lowered somewhat. And then we'll decide in a dynamic fashion when we have supplies and we see what the demand is, when we can gradually bring more starter doses in. But there are more and more products coming all the time.
Lars, I struggle with, an addiction, I would say, to ice cream and extremely weak willpower. So I'd love to get on one of these, but I'm worried about the stomach problems I hear about. There are reports of suicidal thoughts, and I'm terrified of needles. Is there any way you can address those issues in a new product?
Well, we have studied this product comprehensively. We have also done just recently this huge outcomes trial called SELECT. So when you look at the totality of the evidence of the product, we feel that it's a well-established safety profile as stated in the label. So we don't see any signs of suicidal increase or anything like that. The needle part I cannot take away from you. We are also studying the product in an oral administration, so it can come potentially as a tablet. But for now, you will have to take it as a weekly injection.
Well, when can I get it as a pill? And is it going to be as good as or better than the pill products coming from Pfizer or Amgen?
Well, I cannot talk to competitive products because I have limited insights to that. But I can tell you that we have studied a higher dose in obesity of semaglutide as an oral administration, which shows to be comparable to what injectable therapy can give. Having said that, I would also say that we hear that many patients actually like the weekly injection. So the efficacy you typically get from an injectable product, which is higher, and the convenient weekly injection is actually, for many, a very attractive dosing regime. But I, of course, also accept that some are afraid of the needle. But you should have a close look, because it's actually a very small needle, and most would not be able to really feel when you take the injection.
Well, in addition to when Matt can actually get this in pill form, there's a lot of questions around when insurance will cover some of these products. What are your expectations around the timeline for Medicare inclusion for Wegovy?
Yeah, this is something that's being debated a lot in the U.S. Right now, in Medicare Part D, it's not allowed to provide for anti-obesity medicines. So it takes a law change to open up for that. I believe that's being closely debated in Washington, and it could happen sometime in the future. I don't really know when. In the meantime, we see that we are gradually expanding the access in the commercial space. We have now access to some 50 million Americans having commercial insurance, and also some government coverage. So we see it gradually opening up, and we see a broad access that we can address. And most of those patients are, facing a very low copay for getting our medicine.
In addition to obesity and diabetes, of course, Novo is studying GLP-1s in everything from Alzheimer's to osteoarthritis. When you think about these other indications that you're looking at, which of them seem most promising?
Well, I think we have also just seen that there was a so-called FLOW study studying use of semaglutide for patients living with diabetes and kidney disease. And that was actually stopped at an interim data point because it showed to be highly efficacious. We haven't seen the data yet, but it was stopped early because of its profile. So it's really exciting to reflect on a number of diseases in this cardiometabolic space, and add to that Alzheimer's, where it really shows that semaglutide and its unique profile, being an anti-inflammatory agent, can lend itself for a number of diseases. We still need to see the readout. We have seen the readout in cardiovascular disease and the reduction in 20% risk of cardiovascular disease. We'll discuss the data in the upcoming conference here in a few days, American Heart Association. So I think that's the first exciting point, that's in cardiovascular disease.
Well, I don't need to tell you, Lars, that in addition to other drug makers, you have everyone from snack makers to retailers, et cetera, airlines warning about the so-called Ozempic effect. What are your thoughts on that? Do these drugs actually have that far-reaching of an effect in your view, or are some of these concerns a little bit overblown at this point?
I think it is established that obesity is a leading cause of a number of comorbidities, follow-on diseases, but obviously also snacking and the like. I think some of the speculations around how it impacts the food industry and the drinks industry is perhaps a bit exaggerated. But I think it underlines that for the first time we really have an efficacious way to address weight, something that is a concern of a large part of the Western society today. And many patients have been trying to lose weight in all kinds of different ways, have not succeeded, and now there is actually an efficacious way of doing that. So I think it brings a lot of hope to patients. I think it brings benefit to the healthcare systems in terms of mitigating some of the cost associated with follow-on diseases. And obviously that's a fantastic opportunity for the industry, and not least Novo Nordisk being active in this particular space.
All right, Lars, really appreciate your time on what I'm sure is a very busy day. Our thanks to Lars Fruergaard Jorgensen. Matt, back to you.
Katie and Lars, thank you very much for that fascinating topic that I think a lot of people care deeply about. Coming up, markets are facing a crucial 24 hours. As if we didn't have a crucial 24 hours behind us, we're looking ahead to Apple earnings, and then the U.S. payrolls report with Crossmark's Victoria Fernandez. She joins us next. This is Bloomberg. This is the countdown to the open. I'm Matt Miller in for Jonathan Ferro. Moments away from the start of trading, we see futures up almost 1% on the S&P, gains on NASDAQ futures and Russell 2000 futures as well. The Russell down almost a third from its peak. There's the opening bell. Let's switch up the board and take a look at some of the other assets you may want to focus on in today's trade. The euro dollar right now trading at 106.55. I think the 10-year yield is the most amazing. Now it's back up to 465.49, but it was down to 462 and change a while back, like 10 minutes ago. NYMEX crude at $80.88. It's just moving around in a range. They're sort of giving up the gains that we saw a couple of weeks ago in the 90s. One stock to watch at the open is Starbucks. The coffee chain's revenue beat expectations with consumers still drinking their lattes even in tough economic conditions. The CEO saying, quote, "In the face of macro uncertainty, we remain confident in the momentum throughout our business and headroom globally." Abigail Doolittle has more on this stock. Abby?
Well, Matt, investors really liking this report quite a bit, given the fact that the stock is surging up more than 10%. Its best day since March of 2020. The stock is now higher on the year. Going into the report, it had been down just about 9% or so. Having a lot to do, of course, with those famous pumpkin spice lattes, along with some of the apple croissants, helping the company to achieve record revenues that beat estimates, in fact, by roughly 10%, or excuse me, 1%, $9.4 billion or thereabouts. Adjusted earnings of $1.06. That was a 10% beat. But the comp sales of 8% beat the estimate of 6.3%. So strength right across the board. And some analysts are saying that what investors really like is the fact that the U.S. seems to finally be recovering. There was a sequential improvement in traffic versus the year over year and 2019. The U.S., of course, has been weak. So right now, investors, again, really liking these results from Starbucks as folks are buying more lattes than they had been. And the guidance, even though it's a smidge light, investors looking right past that.
For now, right? I want to point out, Abby, that if I could just get some Wegovy, I could probably phase out the lattes and the apple fritters from Starbucks. Abigail Doolittle there on S-Bucks. Turning now to fintech PayPal, on track for its biggest gain in nearly a year after boosting its profit outlook. The new CEO saying, quote, "We must harness our strengths and put the weight of the organization behind our most important priorities." Ed Ludlow joining us from San Francisco with more. Ed?
Yeah, good morning, Matt. PayPal's pared some of its early gain, currently up 4% and on track for its biggest jump since February of this year. At the open, had its biggest jump in a year. And as you said, this is about the volume of transactions coming in on the platform way above street expectations. $387.7 billion of total payments, a gain of 13% year on year and ahead of expectations. They also raised their EPS guidance for the full year to grow by 21% to almost $5, $4.98 per share. We have a new CFO at PayPal as they rebuild the C-suite. Jamie Miller comes in from Ernst & Young effective November 6th. And remember, this is Alex Chriss, the new PayPal CEO's first earnings report. He's essentially a month into the job. One kind of surprise disclosure or more negative news, but it's not really weighing on shares, is that PayPal has received a subpoena from the U.S. Securities and Exchange Commission relating to its work on a dollar-linked stablecoin, which you'll find interesting in the context of the crypto show. The subpoena is asking PayPal to hand over documents tied to that project, and PayPal says in a regulatory filing that it is complying with that request.
Absolutely fascinating. All right, Ed, thanks very much. Ed Ludlow there. He co-anchors Bloomberg Technology every day. You can catch him at noon with Caroline Hyde. Let's turn to fitness now. Peloton falling after delivering a weak outlook for quarterly sales. The CEO writing in a letter to shareholders, quote, "We were less successful at engaging and retaining free users and converting them to paying memberships than we expected. This will be a long-term work in process." Isabel Lee has more on Peloton. Isabel?
Hey, Matt, the stock is now paring some of its losses after being down by almost 10% in pre-market trading. Now it's up slightly by around, it's kind of flat actually, but still it's a reversal from the glory days that we saw during the pandemic when sales really plunged now that people are back in the office and gyms reopened. Maybe their Pelotons are probably gathering dust. Peloton said sales will be between 715 million to 750 million, so that's well below the analyst estimate. The company sees full-year revenue coming in flat, and when it comes to app subscriptions, the company expects it to fall around 6% during the fiscal year. So Peloton really has struggled to convert some of its users into paying customers, and in a bid to slash costs, the company has offloaded businesses, laid off workers, and shut down some of its retail stores. Even so, of course, the CEO is optimistic that they will return to growth in the second half of the year. He credits this to new programs and partnerships like companies with Lululemon. And for context, Peloton is now down by around 40% year to date. It's on track for its third straight year of losses after a 450% gain in 2020, Matt.
All right, Isabel, thanks very much. Isabel Lee talking about Peloton there. I want to just quickly tell you that Ford has Ford and the UAW, with the deal that they made, they have won the first local vote in a key step towards approval of that deal. Of course, the union still has to ratify the deal that its leaders made with the executives over at Ford, and it looks like at least that's heading in the right direction. Ford shares up 1.5%. Let's turn to the streaming space. Roku reported better than expected revenue. The C-suite is writing in a letter to shareholders, quote, "We will continue to operate our business with discipline to defend margins with a focus on driving positive free cash flow over time." Katie Greifeld back with more on Roku. Katie, what do we know?
Well, Roku is absolutely flying today, and we know that they added more new users than expected in the third quarter. To get specific, 2.3 million new accounts. For context, analysts had expected about 1.8 million new accounts added in the third quarter, so a big beat there. You add that together with Roku's sales rising more than 20% year over year to $912 million. That topped the consensus estimate of about $857 million. Now, all of that was good enough news to outweigh the fact that you did have losses swell more largely than expected. In the September quarter, that came in at $2.33 a share. Analysts had been looking for a loss of $2.08 a share for the third quarter. But even still, you take a look at the sell side right now, and they are psyched about some of these numbers. JP Morgan writing that what really stood out was the profit upside, and Piper Sandler noting that Roku is executing well amid this uncertain environment. You add it together, shares currently up, about 16% right now. That is the best day since July, adding on Roku's 70% year-to-date gain.
Wow. On fire. All right, thanks very much for that, Katie Greifeld. Now, Crossmark's Victoria Fernandez weighs in on consumers, so important to this economy. She writes, quote, "They continue to be a piece of the foundation that is holding up the markets, even with the headwinds we currently face." She joins us now. And Victoria, I've got a list of concerns about the consumer, starting with the drop in the savings rate, going to putting so many more purchases on credit cards. I think I saw this morning that for the third quarter in the row, consumers who could pay a $400 emergency payment can't do it in cash. And we have student loan payments resuming. So can we be at all optimistic about the U.S. consumer?
Well, I never want to count the U.S. consumer out, Matt. They always seem to come back and have some strength when we least expect it. But you're right, there are quite a bit of headwinds facing the consumer. You look at the first 9 months of this year, and we actually saw disposable income for consumers up pretty significantly. That's turned around in the last few weeks. We're starting to see a little pullback there. But consumers, their net worth has actually increased this year. And so their need for savings has declined. And I think that's a nuance that we forget to look at when we're saying, oh, wait, savings is coming down. There's not as much cushion there. The consumer doesn't quite feel it that way. And obviously, tomorrow is the labor report. If the labor market continues to be strong, we had jolts already this week. Those job openings continue to be there. We do see quits. The number of quits starting to come down a little bit, which tells us maybe we start to have a little leveling out here, but the consumer still has strong wages. They still have some money in savings. Their net worth is higher, and we are heading into the holiday season where spending is going to continue. I think where we're really going to see the consumer get hit is probably the first quarter of next year, and it's one of the reasons maybe we saw the market pull back a little bit over the last couple of weeks, minus what we saw yesterday and today.
How hard do you think that hit's going to be, Victoria? Because, I feel like once the tide turns and we start to see the joblessness rate rise at these interest rates, if you've got, a big credit card bill that you're rolling over, it's going to start to really hurt.
It absolutely will, and that's key. It's no different than you look at the government, right? We've got interest expense that's 14% now of our tax revenues. You're going to see the same thing when it comes to the consumer. After, I think, the holidays, when we'll see some of that revolving credit and those credit card balances increase, and we're still at high interest rates, it is going to start to hit when we're also not going to see the level of wage increases that we have seen over the last couple of years. The consumer will take a hit. The question is the high-end consumer going to be able to step in and keep that foundation under the economy that they've been able to do, or are they going to pull back as well? I think we're going to see a pretty good normalization or pullback from the consumer heading into the beginning of next year. I think it's why, even though we're having a little bit of a rally right now in the equity markets, we should still be prepared for a larger pullback or mild recession coming. And we're seeing it a little bit in earnings expectations being pulled down for 2024 as well, as pricing power is drifting away from companies.
So, we have seen 4 days in a row of decent gains for equities. We've seen investors going in to buy treasuries, pushing the yields down. Right now, we're looking at the 10-year yield at 4.6. Is that, you think, good for equities, or is it worrisome because the Fed did leave the door open for a rate hike if needed?
Yeah, it's a conundrum really when we look at it, because I think a lot of what we saw with rates moving higher previously was the market actually anticipating that the Fed was going to continue to increase rates. It's kind of like a self-fulfilling prophecy. So yesterday, even though we didn't really get any new news from Powell, he did take some of the hawkishness out, even though they left it open for another rate hike, which I will say I won't be surprised if we get one more. But I think the market is saying, okay, we're probably getting close to peak. They're going in and locking in some of these rates, but they're also seeing that inflation expectations are not becoming ungrounded. They're liking kind of where that's moving right now. And we saw unit labor costs this morning really drop, and that's going to be positive for the companies as well. So there's some reason that we're seeing the yields come down a little bit. And I think we probably did hit the high at a 5% on the 10-year Treasury. We've been buying in the longer end of the curve, locking in rates, doing a barbell with buying in the shorter end as well. And I think that people would be wise to do that.
I missed it. I'm kicking myself. And this equity rally, the biggest 4-day rally since January, I'm hearing from the control room. So really a lot of conviction, it looks like, behind this. What do you like, Victoria? Do you just buy a basket of the Magnificent Seven? Do you like an index? The Russell 2000 has been absolutely crushed since its highs. Are there sectors that you're interested in? Tell me what you like.
Yeah, so I think you have to be careful here, though, Matt. We're not saying this is a sustainable bull rally. We've been in a position, some contrarian indicators saying it's time for a little bit of a rally. But again, we think we're going to see a bigger pullback. So we like some of the names like in the healthcare space where we have a little bit of defense still in the portfolio. But we think as names have pulled back over the last few weeks, you can go in and buy some things. Lowe's is a name we like. With housing, having the issues that they're having, home improvement will probably pick up a little bit, and we've seen the valuations come down pretty significantly there. And Adobe in that tech space, that's a name we like as well. So I think you need to spread it out, have a little diversification. But look, interest coverage is the #1 factor in the S&P 500 right now for best performance. So look at quality companies. Don't just go in and buy something because the prices come down.
All right. Great context there. Thank you for reining in my sensationalism. Victoria Fernandez from Crossmark. Coming up, investors hoping that Apple results will help salvage a mixed earnings season for the mega cap tech stocks. That conversation next. This is Bloomberg.
The iPhone remains like an exceptional product. This is the only phone at a 3 nanometer manufacturing node for the main chip, exceptional quality, exceptional like integrated software and hardware, etc. So I wouldn't say the Chinese are going to put out a phone that can compete with the iPhone, but we know that in the past, about 20 million phones were selling at Huawei, and when Huawei disappeared, that market seemed to have moved straight into Apple's hands, and that's a concern.
Pierre Ferragu there of New Street weighing in on Apple. But first, chip giant Qualcomm delivering a better than expected revenue forecast, casting hope for a smartphone market rebound. The company's CEO, Cristiano Amon, writing, quote, "As we enter fiscal 2024, we are pleased with our roadmap and product execution, which positions us well across our businesses." Bloomberg's Katie Greifeld here with more on Qualcomm. Katie?
And to get specific on that forecast, Qualcomm expects that sales will be $9.1 to $9.9 billion in the fiscal first quarter. Now, the midpoint of that range is about $9.5 billion. That is well above the average analyst estimate for about $9.3 billion. And of course, Qualcomm, it's the largest maker of smartphone chips. And like you said, these numbers offer some hope that maybe the inventory glut in the smartphone industry starting to be worked down, perhaps as consumers finally start to upgrade their smartphones, especially in China. Qualcomm said that it expects revenue from Chinese phone makers in particular to jump 35% in the current period. Now, for right now, phone demand remains slow, but you take a look at the shares right now, that optimism working its way through. Qualcomm currently up about 6%.
All right, Katie, thanks very much. Talking a little about China, and that's very important for Apple. Reporting today after the closing bell, investors are going to be watching iPhone 15 sales and the device's performance in that region, where some early sales estimates have been sluggish. Bloomberg's Ed Ludlow is back with more from San Francisco. Ed, what are we looking for from Apple?
Yeah, the reality is that on the top line, the expectation is this will be the fourth straight quarter of sales declines that Apple will see. And you have to go back 2 decades to find a slump like this for Apple. You're completely right that the iPhone 15 in the context of China will be a focus. The iPhone 15 went on sale September 22nd, meaning there was about a week left in the quarter of sales that will be reflected in the fiscal fourth quarter financial results. But the third-party data has not been good. Basically, in layman's terms, the first 30 days of sales of the iPhone 15 generation in China in particular had been high single digits below the first 30 days of 2022 when the iPhone 14 went on sale. And as Pierre Ferragu was just discussing in that soundbite, everyone accepts the technology leadership, the cutting-edge in-house processor or silicon inside the handset. The question marks are around the responsiveness of the consumer. I use MODL and look at kind of multiple periods, but you also get a good breakdown of the segment revenue. One bright spot is services, projected to have top-line growth of around 11 to 12% in the quarter. And you'll note, Matt, that some news that went a little bit under the radar is that Apple raised prices across its services and subscriptions recently. That might be a boost. Is it enough to swing the tide? And even though iPhone sales fell year on year in the prior quarter, they'll swing back to a modest gain on the top line this quarter. Why? Seasonality. We're heading into the holidays, and that also often coincides with the launch of a new generation model, like the iPhone 15.
Well, and we're looking for, a positive outlook from Apple that will drive growth in the shares. At the same time, Ed, if we get a downturn in the economy, people are going to flock to this stock as a safe haven, right? Because they have like $170 billion in cash and equivalents, and the free cash flow is insane as well. It's amazing that this is a growth, tech growth company and also a place where people seek safety.
I think it really depends on how much has changed since the last earnings report, because the narrative or commentary from Tim Cook and Eddie Q, the CFO, was consistent with what you just said. They told us that the smartphone market, particularly in North America, was weak. The point of difference was that in the fiscal third quarter, China was a swing. It swung heavily to a gain driven by iPhone. But then the narrative changed, right? They had told us in the fiscal third that going into the end of the year, iPhone would accelerate, including in Greater China region. The third-party data that has subsequently been released contradicts that. On the cash on the balance sheet, we talk about this every quarter. Largely, I guess the story is around buybacks and returning shareholder value, because they ain't going to be out there shopping and buying something ginormous at this stage.
All right, Ed, thanks for joining us on that. Ed Ludlow there out of San Francisco. No one has a better view of the tech sector than Ed and Caroline Hyde, and they anchor Bloomberg Technology every day at noon. So definitely going to be all over the Apple story today and tomorrow from them. Definitely don't want to miss that show. For some of the sector price action this morning, let's get to Bloomberg's Abigail Doolittle. Abby, what have you got?
Well, Matt, we are heading to the best week for the S&P 500 going all the way back to November of 2022, and today is no exception in terms of that bullish attitude. All 11 sectors for the S&P 500 are trading higher. It's notable also that the index is back above its 200-day moving average. The worst sector, staples and then healthcare, those, of course, are defensive sectors, so that underperformance is actually risk-on or supports the risk-on tone. Up top, real estate, discretionary, energy, utilities. So an interesting mix, but we have basically 8 sectors trading up more than 1%. And here's the story of the week. Take a look at discretionary soaring 7%, tech up almost 6%, communication services up 5%. So those are those mega cap tech stocks that have been hit so hard since July. Well, not this week. And interesting that we also have real estate higher with them. As yields go down, those dividends look more attractive.
All right, very good point on real estate, Abigail. And of course, we're all watching those big tech gains this week as well. Stock gains, bond gains. Coming up, the market moving events that you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for the trading diary, what you need to be watching through next week. Apple earnings coming out today after the closing bell. Then we round out this week with the October payrolls report at 8:30 tomorrow morning. FedSpeak picks up again next Tuesday, along with more earnings from Uber, Robinhood, and eBay. Then earnings from the House of Mouse on Wednesday. This was the countdown to the open. This is Bloomberg.